I don't know how I muted myself. Thank you. Thanks, Anthony. Okay, just to get us started, make sure we have time for everyone's questions today. We will get started. I will continue to admit folks as they join us. Really appreciate you joining us today for our third webinar of the year. This one focused on everything to do with valuing and financing and really making sure that we're best prepared for employee ownership transitions. As ahead of time as possible so that we can make the most out of these transactions and set them up for success and also set them up for maximum value for our owners. We've had two other webinars this year. If you didn't get a chance to attend those, you can find the recordings on our website. We have had a session on different types of employee ownership models, and we've also done a deep dive on employee ownership trust. So if you didn't get a chance to, you can check out the recordings for those online. And of course, if you do have any questions, there are lots of resources on our website, or you are welcome to reach out to us at info@employee-ownership.ca. Sorry, I'm continuing to admit people as we go, but we will jump into our session for today. And I just want to quickly introduce your speakers who will also give their backgrounds as we go through our section. So we're joined today by Andrew Day, who is a chartered accountant and business valuator, and Anthony Carbone from BMO, who is a commercial banker, to talk about different financing options for transactions. So on our agenda today, we're going to talk about transaction processes and specifically some of the difference between an internal and an external transition. And Andrew's going to step us through that. We're going to talk about business valuation fundamentals. And then we're going to transition over to Anthony to talk about our financing options and how you work with your bank and the bank's perspective on these deals so that you can get some information about what that financing process looks like and what the options available to you are. And most importantly, we want to structure this session today to get your questions answered. So please, at any time during the session, you can raise your hand, you can write questions in the chat, and we will do our very best to answer all of those. We also don't disappear after the webinar, so should you have specific questions about your situation afterward, then you can connect with Employee Ownership Canada or with Anthony or Andrew to get those answered. One other just note, as always, this is an educational session. It is not meant to be tax, legal, or financial advice specific to you. You should always consult your accountant, lawyer, or other financial professionals before making specific decisions about your business. With that, I want to kick us off by turning the floor over to Andrew Day to talk about a bit of an overview to introduce us to the process itself, and then we'll talk a bit about business valuation as well. Andrew, would you like to introduce yourself?
Yeah, good morning, everybody. Thank you for joining us today. As Justine said, I'm Andrew Day. I spent most of my career working in valuations and transactions advisory work. I have recently retired from public practice on a full time. Part of my new job is working with Employee Ownership Canada, really as a resource for them. So I would welcome anybody that has any questions at the end of this session or want to reach out to me individually, confidentiality wise. I will put my email address in the chat box as we go through this, because with the limited amount of time we have, you could basically spend a day in any of these topics, and it's a little overwhelming. And for me, the objective here is to elicit more questions than give answers. So my offer out there on behalf of Employee Ownership Canada is to answer any questions that you have or talk you through any processes on a confidential basis, free of charge. It's a service that's being offered through Employee Ownership Canada, and it's one of my give backs to the community is to do that and assist in any way possible with any people that are looking at selling or just want to get an idea of where to start the whole process, because as I say, it can get very daunting. So the overview, we're going to start with just looking at the transactions process. And again, at the end of the day, whether it's an internal or an external sale of your business or the shares of your business, the outcomes are the same. You're an owner that's looking to retire, looking to get out, or looking to sell your company for the best price with the best terms that you can get. And once you've negotiated that, consummate the deal, walk away, and have a happy retirement. Now, the end result is the same, but the methodology for getting there is very different between an external sale and what we're going to call an internal sale, which would be selling to family, to employees, or a mixture thereof. You're probably all more familiar with the external, where it's like, I really want to think about selling my company. I don't know where to start. I don't know how much it's worth. So I'm going to go to a business broker and get them to do everything for me. They will identify potential buyers out there in the marketplace for me, most of whom I wouldn't know. They will identify, they'll start the courting process. They will elicit term sheets from one or two or a number of potential buyers who will then go through the process with you of being introduced to them. And in these situations, you're typically looking at selling 100% of your company. So really, your control over this is pretty much dictated by external forces, by being your broker and the valuation process that the broker may undertake on your behalf, or something that you may do on your own. Offers are assessed. You will have a term sheet or an LOI agreement that sort of sets out typically what the major terms of any deal are going to be. And then the potential purchaser is going to come in and do their due diligence. They want to look under the table, under the sheets in the closet, look to see what your company is about, because they may not know much about your operations, about your company and the financial processes, your customers. So they really need to do a deep dive into that process. And depending on the size of your business and the complexity of your business, or if you have a number of different revenue streams within your business, then that process can take time. Once the due diligence is complete, you will normally go to the drafting of a share purchase agreement. That will be done with your legal team, their legal team. You sign the deal, and then after the deal, it depends on the terms of the deal. Are they asking you to stay on? Is part of the deal going to be on an earnout that you're getting some money now and some money later? And or you want to walk away with the money in your pocket and go to the beach tomorrow. So all of that will be fleshed out into the agreement, and will really dictate the final price that you get, depending on the deal structure. And so, your involvement is very sporadic. It's you're waiting for them to come back to you with any more questions on the due diligence. So, and depending on how long it takes to expose your business to the market, you could be looking 6 months plus to get any sort of traction on a deal and get a deal done. Now, we're more looking at employee ownership based deals here, which are the internal deals. So, in these situations, first of all, you will have an idea of who your buyers are going to be, because it's going to be your employee group. And whether it's a key group of employees, whether it's all of the employees, I mean, there's a different scenario for every company. There's not a one size fits all. And it really is dependent on your objectives, how you want to structure this. You really are in control of the whole structure of selling to your employees. And theoretically, you could be selling anything from 1% of your company to 100% of your company. And again, you'll run the gamut depending on where you are in your life and what you're looking for at the end of this whole process. And so, once you've identified your buyer group, then you're engaging with your employees and saying, look, we thought about this, and we'd like to start inviting some of the employee group to participate in the ownership of the company. And so that process will start. You will then be the one that engages your professional team. And obviously, the first thing is, well, what's my business worth? How much should I be selling it to the employees for? So you will normally engage a chartered business valuator to go through that process with you and prepare a valuation report. We can talk about the levels of reports a little bit later, or if you come up with questions. Uh, but typically the valuation process from start to finish can take maybe 3 to 6 weeks. Again, depending on the complexity, the availability of information. The report is prepared in draft. You will be sent a copy of the draft to go through. You will meet with the business valuator, go through it, ask any questions you have, any concerns, any assumptions that have been used that maybe aren't quite right, and you will the end product will then be your final valuation report, which will give you an indication of what the company is worth. And at that point, what normally will happen is you will start to engage your potential ownership group, new employees. You will talk to them about this process. And if I could just take a step back, I would say that communication and transparency are very key in employee ownership transactions. And so the earlier you can engage the employees and tell them about the process, tell them about the valuation process, where that's going, so they're not sitting there wondering what's going on, when are we going to have our next meeting. You don't want the anxiety levels to be raised more than they need to be, because this is a very emotional time for everybody. Selling part of your legacy, your business, and for the employees now taking on a new responsibility financially and otherwise, and coming into the company. So trying to keep everybody engaged and keeping the anxiety levels down. I'd say if you don't take anything else away, take that away, because that is very, very important and very key. And then having said that, once the valuation report has been completed, you will share that valuation report with your employees or the group that are coming in. And you would encourage them to have their own independent financial advisors, accountants, whatever, look at the reports, go through with them so they're comfortable with the report. And then what I've always found useful, and again, this is another key to a successful and smooth transition and transaction, is that the owner will invite the employee group with the business valuator to go through the valuation page by page, line by line, so that everybody's very clear about the process, how they arrived at the valuation, the assumptions that were used, so that they get an idea of where this number has come from that they're going to be paying for the shares. Now, at that point, the employee group will say, yes, we'll take it away. We'll talk about it. We'll come back. We'll have meetings. The more meetings, the number of meetings that you need, there's no magic number. If you need more to make everybody feel comfortable, by all means, there's no set rule for the number of meetings that you should or shouldn't have. The end result is to have everybody comfortable with the process going forward. So when the group eventually meet and any questions have been answered, any concerns have been dealt with, then you may go to an LOI process, letter of intent, where the employees will sign a letter of agreement to say that we want to proceed to the next step in the purchasing process. Now, unlike an external transaction where the potential purchaser knows nothing about your business, your employees are probably fairly intimately versed in the internal workings of the company, the relationships that you have with your customers, the corporate culture. So any due diligence process in an internal transaction is going to be a lot less onerous than an external transaction. And so once you get through that process, again, you're going to paper in the deal, having a share purchase agreement drawn up that everybody will have to sign on to, the buyers and the sellers. And this is one thing where it's very important to make sure that you don't cut costs on your legal costs in getting a share purchase agreement together, because a bad share purchase agreement can lead to a lot of issues as you get to the point where you're closing the deal. And there's a lot of areas that come in that need to be dealt with, and some of them may be a little bit difficult to deal with or awkward to deal with. But it's it's like a new marriage. When you go in, everybody's full of love and everything's happier. It's wonderful. We're going to be working together forever. So maybe it's a good time to have those awkward discussions there and then, rather than 5 years down the road where something has gone very bad and you didn't have that clause in your agreement, and now you're having to address it when everybody's in a litigious mode. And so that is always an issue that you want to avoid at all costs. So making sure that your share purchase agreement is well drafted and every eventuality has been thought of. Now, unlike an external transaction where you're not going to be involved post closing because you're probably selling 100% of your shares, and if you are staying on, it's going to be in an advisory transitional role with the new owners of the company. Whereas with an internal deal, you may only be selling a portion of your shares and you will be staying on, maybe as a majority shareholder, maybe not, but you will still be a shareholder. And so the next document that's critical and key to get prepared and signed is the unanimous shareholders agreement. This is the agreement between all of the new shareholders of the company. And again, we'll deal with just the conduct of shareholders, how shareholders will treat each other. And it will have clauses in there for what happens in the triggering event, what happens in the event of a death or of an insolvency, or mental capacity issues or divorce, or the employees decide to leave the company or get terminated. And the shareholders, how do you deal with that within the process of the new share structure of the company? And in addition to that, there may be a situation where you say, well, going forward, we may want to bring in more employees as shareholders, or what happens if one of these shareholders wants to get out? You should have a clause in there that at least addresses the mechanism, how you're going to value those shares in the event of an exiting event, as opposed to when you're coming into the company. So again, that's something that needs to be dealt with. And again, it is money well spent to make sure that you have a good share purchase agreement put together. Again, unlike the external transactions, an internal transaction typically tend to have a shorter time frame from the start of engaging the process. And if it's well structured and well organized, a 3 to 6 month period is not unusual to see a transaction consummated. But again, it's all down to the planning and how you conduct the whole process as you go through it. Now we'll get to the valuation itself. So, what are the fundamentals of valuation? How do we begin to value the company? Well, the fundamentals are the same whether it's an internal deal or an external deal. The first thing you need to look at is the level of report that you want to get done. And similar to financial statements, where you have compilation engagements, you have review engagement statements or audits, there are 3 levels of valuation also. And the level of valuation really depends on the amount of work and time that is put into it. And obviously, the higher level of valuation, the more detailed, in-depth, and the more credible that report will be. In our practice, and I think Anthony will probably agree with this, that you never want to see anything less than an estimate valuation report, which is akin to a review engagement financial statement. Which is doing a little bit more of a deep dive into the business. And you may say right away, well, I know all about my business. You don't need to tell me that story in a report. And my employees know about the business. But at the end of the day, if you're going to have any external financing or any other areas where you're going to need to look at financing and funding, the credibility of that report may be key in getting the financing and getting your deal done. And also from the employee's perspective, it does give them a little bit more added comfort that you, as the owner who have engaged the evaluator, he's not your hired gun. He's not working for the owner. He's there as an independent expert to give an objective view and opinion as to the value of the company and the shares. So again, I would suggest that costs are an issue, but don't penny pinch and cut corners and costs by opting for a lower value report. So again, that's something that you can talk to the valuator about. You can see the level of confidence or comfort that you're going to get from that report. So, the process itself can be very, very daunting. So once you've engaged the valuation expert and you have decided on the level of report that you're going to go ahead with, then you're going to get inundated with requests for information. Best practice usually is that the evaluator will send you one list of all of the information that they're going to require to complete the engagement. This list can be fairly extensive, and off the bat, you say, well, why do you need this much information? Well, like financial statements, business valuation reports are governed by a professional body, and there are certain standards that have to be met, and so certain information has to be reviewed in order for the assessment to be made on the value. So at that point, you may want to get your own accountants, your own financial people involved to help you get all this information together and navigate, and even have them tell you, well, why are they going to need this information? And at least your own financial advisors will be able to help you navigate through this whole process. And it certainly will make the process less daunting for you as an individual if you have your own trusted advisors helping you through the process. Also be prepared for questions. And a lot of these questions, quite easily and happily defer to your financial advisors or to your legal advisors and say, yeah, well, they're probably better versed and more equipped to give the answer that you need than me. And so your involvement can be whatever you want it to be. But the more you involve your own professional advisors, then again, your anxiety levels are going to be reduced. And again, we come back to, we want to keep the anxiety levels as low as possible throughout the whole process. Once the report's finished, that's when you sit down with the evaluator and your own internal or your own professional accountant, go through the report, ask any questions, and come out to the final conclusion. I don't want to take up too much more time now. I mean, there's a lot of other questions, a lot of areas we can go into here, but I'm mindful that I want to make sure that Anthony gets his time. There will be time for lots of questions, and as I say, I will be happy to answer questions during this time we have left, or on the phone with anybody that wants to, or by email. So at this point, I think I'll hand it back to you, Justine, for the next leg.
All right. Thank you, Andrew. So as we've sort of queued it up, we figure out internal, external, we get a value for the business. We start talking with our staff. The one big component, of course, is that we have to figure out how we're going to pay for all of this. And so when it comes to financing these deals, that's one of the most common questions we get at EOC. And so I'd welcome Anthony to introduce yourself, and then while you're doing that, I'll pull your slides up so we can walk through what your financing options are.
Perfect. Thank you. So hey, everybody. My name is Anthony Carbone. I've been with BMO for about 13 years now, spanning capital markets and commercial banking. I'm currently managing director and team lead within the commercial banking team at BMO, and my team specializes in financing businesses using senior debt under cash flow structures. Before we jump into specifics, I'll take a minute or so just giving you all context on how we think about employee ownership at BMO. So at a high level, employee ownership touches more than just lending. Ownership transitions raise questions around valuation, financing, taxation, estate planning, governance, and long-term personal planning for founders. One of our strengths as an institution is to be able to address these questions across our platform rather than in silos. Our clients have access to commercial banking, treasury and cash management solutions, family office and wealth planning services, advisory support around succession and M&A, and where appropriate, subordinated capital or minority equity, all aligned around your single transition plan. So from a corporate expertise standpoint, BMO has been active in financing employee ownership structures for decades in the US, and we've been an early advocate for bringing EOTs to Canada. That history is extremely important because these are not standard transactions. They require a strong understanding of cash flow-based lending and long-term business sustainability. So while we're vocal supporters of employee ownership, our focus isn't on promoting a specific financing structure. Our focus is on helping business owners evaluate their options and determine which transition approach best fits their objectives, risk tolerance, and timeline. So from there, our role is to provide disciplined advice through thoughtful financing and the right resources to support a successful transition. So let's start with the big picture. Employee ownership is definitely a life-changing opportunity for both the employees and the owners looking for a meaningful succession and legacy. A common challenge that we see in this transition is a relatively simple one. The employees usually don't have enough personal capital to buy a meaningful stake outright. And this is where external financing becomes critical. So when financing is thoughtfully structured, it becomes the bridge between an owner who wants the liquidity and a clean succession and an employee who wants ownership but can't write a large check on day one. Our role as a bank in the ownership transition is effectively threefold. So we pressure test what can be financed early on in the process. So this is before the deal terms are locked in. We structure finance capital around cash flow and not just around valuation. And we focus on supporting business stability post-close with the objective of enabling the company to operate, invest, and grow while remaining aligned with its corporate values. So the most important advice I can provide up front is don't wait until the last minute to talk to your bank. The best outcomes typically happen when financing considerations shape the structure and not when they're brought in to make the structure fit. When done well, financing delivers liquidity for the selling owner. It allows broader access to ownership for employees, and it provides a faster and cleaner transition of a larger share of the ownership piece. So if we can just hop to the next slide there. Now we can talk about some tools in the toolkit. There's really no single financing solution that fits every employee ownership transaction. In practice, we often see multiple layers of capital working together. So this slide shows the different types of capital that's available when it comes to financing an ownership transaction. I'll briefly cover the most common types that we see. So the most common type is the senior loan. So this is typically the lowest cost, most traditional bank financing, and it's really a foundational element of the structure, if you think about it. Senior loans sit at the top of the capital structure. They are the first ones to be repaid and serviced. They're structured with regular principal and interest payments. And the size of the loan itself is driven by what the business can safely and predictably repay from cash flow. Banks will also include financial covenants, and you could think of these as guardrails to make sure that the business remains financially healthy while providing your banking partners with a predetermined checkpoint along the way that provides insight into the business's performance. So in tandem with senior loans, you typically find vendor financing, and vendor financing is very common in employee ownership. The selling shareholder defers part of the proceeds and is paid after the bank is repaid. It helps bridge valuation gaps, and it provides comfort to the bank in that the business will continue to perform after the sale. We have other types of financing like mezzanine financing, and this sits between debt and equity in the capital structure. So mezzanine financing is more flexible. The flexibility comes at a cost, and it is often used to fill gaps when senior debt alone doesn't push, or where senior debt alone would push leverage too far. Finally, we have equity, which I'm sure you're all familiar with, and personal loans to employees, which are sometimes used for equity stake sales to leadership teams. It's an effective option, but it introduces personal risk that needs to be approached carefully. The structure we'd ultimately consider is something that is bespoke to your company's specific situations and to your needs. There's creativity involved in this process, and as analytical as banking can be, deal structuring is both an art and a science. It's important to keep in mind that from a bank's perspective, creativity works when it reduces risk and not just when it increases the finance proceeds. So for example, refinancing real estate can sometimes fund part of the transition on longer duration capital, or asset-based lending can improve liquidity, but it comes with tighter reporting. So the common thread here is that financing works best when the assets are matched to the right capital. The next slide. Thank you. Okay, so now this is where the banker in me can come out. Before any financing is improved, banks need to understand just how much debt the business can reasonably carry. So we typically focus on three core areas. We focus on cash flow as the driving force. So it is the primary driver of our analysis. And increasingly, banks focus on free cash flow and not just EBITDA. So that means that we look beyond headline earnings and we ask ourselves, how stable is your cash flow? What are your working capital requirements? How predictable has operating performance been over the last 3 to 5 years? Are margins sustainable? What does your CapEx need look like, both from a growth and sustainability perspective? So at the end of the day, the loans are repaid from your cash flow that is generated by the business, and we need to ensure that we're comfortable with the business's ability to continue to perform in different types of macroeconomic environments. The next thing we consider is collateral. Now, while enterprise value matters in a sale, banks also look at tangible assets. Collateral is important, and we talk collateral, we mean receivables, inventory, equipment, real estate, but it's not typically, it is considered a secondary source of repayment. Strong collateral does not fix weak cash flow. Cash flow is always going to be our primary focus. And then leverage. We look at the full picture of debt that is in the company, and this includes any existing loans that stay in place after the transaction is culminated, any new acquisitions or transaction debts, any vendor notes or other subordinated financing that is on the books. So we really aim to structure in a way that allows the business to comfortably service its obligations while continuing to invest in opportunities and to continue to grow. So numbers aside, there are some other non-financial factors that are equally important from the bank's perspective, especially when dealing with sales of a business or internal transitions. So some of these factors that we consider is management depth beyond the current owner and founder, customer and supplier concentration, and reporting quality, which includes the timeliness of reporting, the ability to generate internal financials, and the accuracy of the forecasts that are provided to us. So from a bank's perspective, strong reporting reduces uncertainty. And as financial markets make clear over and over again, uncertainty is directly correlated to risk. We can move to the next slide there. So if there's one message that I would want you to take away from my section here, it's this one. It's engage with your bank as early as possible. Early engagement with your banking partners retains optionality and flexibility for all the parties involved. Early conversations with your bank make a huge difference. So whether we're just starting to think about succession or already negotiating an employee ownership transaction, engaging with your bank helps you understand what's feasible, it helps you avoid surprises, and it allows you to build the right financing structure from the start. An efficient process relies on clear information and open communication. So from a financial information perspective, typically banks will ask for a SIM, or confidential information memorandum, if it's available. And this is typically produced by an M&A advisor. Historical financial statements from the past 3 to 5 years, as well as forecasts for the next 12 months at minimum. Then we look into your working capital details, so AR aging lists, inventory, and other asset appraisals, if you have them, any other items that might be relevant from that perspective. We need to understand your organizational structure, as well as look into company leadership information. We look at proposed transaction terms and documentation with a valuation prepared by an independent third party, such as Andrew, and any other reasonable due diligence items that may be applicable to your business or situation. Again, very custom, very specific. Most importantly, the relationship doesn't end for us at closing. It's really the beginning of a partnership. Ongoing communication helps identify refinancing opportunities. It helps us manage covenant requirements, and it helps us support the business as it evolves under its new employee ownership. So our role as your banking partner is not just to provide capital, but also to help you navigate one of the most important transitions of your life. And that'll end it for my section.
Thank you, Anthony. I really appreciate you providing us with that overview. We did promise that we would keep as much time as possible for questions. So if you do have any questions, I'm going to stop sharing and we can take those. I can also start us off with some if we don't have any in the chat yet. Just a reminder for those of you that do have questions, you can write them in the chat, but if you'd like to ask them live, you're more than welcome to. Um, in the React section at the bottom of your Zoom screen, if you click on that heart, there's an ability to raise hand, and then we can take you off mute and you can ask your question there. Um, One question that I have for you, Andrew, was just one of the topics that I've heard some business owners talk about is, how do I know I'm getting the best price or a fair price if I sell internally? Is there an ability to test the waters? Do you see people run a dual track? How does brokers uh, valuation of your business compare with an independent business valuators? Do you see people getting a business valuator to look at their business in an external process too? Can you talk a little bit about the difference in value?
Yeah, I mean, really, I mean, all things being equal, the valuation conclusion should be within a similar range, whether it's being done for a an internal or an external valuation. Now, the concept of fair market value in the valuation, the highest and best price available in an open and unrestricted market, has its limitations. And value is only the beginning. It gives you sort of sets the benchmark for what your company is worth uh, under certain assumptions. Now, those assumptions will alter dramatically depending on the terms of your deal. The owners say, well, my buddy down the road, he sold his company for $1 million more than that, than my valuation is saying, or whatever the number is. And it's like, yeah, but the terms of his deal were that he had to stay on for 5 years, plus he only got paid half up front and had to wait for the other half. So it's the terms of the deal that will eventually um, come up with what the price that is being paid for your shares. So there is a distinct difference between value and price, and it's very important to recognize that and to reconcile that back to your valuation report, which is giving you the value under certain conditions, but the way the deal is structured will ultimately determine what price you get for your shares, depending on whether you want the money in your jeans now and walk away and go to the beach, or whether you're willing to stay on for transition process and help the business to continue growing and generating cash flow to get your earning portion of the deal.
Thank you for that. I do think that is one of the important considerations is that you can get fair value for your business. It's not necessarily a charity in an internal transaction. It's very much a liquidity event for the owner, and that valuation process facilitates that. One other question for you along those lines, and then I have a question for you too, Anthony, is what are kind of the three major value drivers, and what can I do if I'm starting to contemplate a sale and I've got maybe a couple years ahead of me to maximize the valuation of my business?
Yeah, I think, as Anthony alluded to in his presentation too, I mean, cash is king. I mean, obviously, strong cash flows are one of the main valuation drivers out there, because when you value your business, what really is you're valuing the present value of your future cash flows that you're going to continue generating as time goes on. So, cash flow is very much a main valuation driver. Obviously, having a healthy balance sheet and not being over leveraged and not having too much debt on your balance sheet again is another area which is going to drive your value. Probably another very important one would be your customer base. I mean, if you're a company that relies on one or two customers for 80% of your revenue, then there's risk involved in that business, and that will be reflected in the valuation because of the risk that's associated with you continuing to generate cash flows from those customers going forward. Whereas if you have a very strong long-term customer base that keep coming back year after year and they've been with you for a long time, and you have that stability in your customer base and also stability in your gross margins, which are either at par or outperforming the benchmark for your industry or market, that's another big value driver. Because if you're lagging behind your competitors and other businesses in that area, then that's going to reflect on your value.
I want to talk a bit about, actually, we have a question in the chat that's on this topic, so why don't we go there? So, typical spread between independent valuation and bank valuation. Maybe both of you can answer that.
I'll jump in on the bank side. I mean, historically, the banks don't provide valuations for the businesses that are looking to sell. We either engage external valuation professionals, or we have M&A advisors, or you go to a big four and they'll have an M&A group. So typically, the bank is the recipient of these reports, and we use them as the basis of our underwriting for any kind of financing that is required. It's a little bit of a conflict of interest otherwise to generate the valuation and the financing at the same time. So I think more, maybe if I could reframe the question, would be more like a open market valuation versus an appraiser's valuation spread. I think that would be more of a, something that we could assess over time. Maybe Andrew can speak to that if he has some experience there.
Yes, thanks, Anthony. Yeah, what I will say is that, valuation is based on certain assumptions. And if you have a number of potential purchasers out there and suitors, then that could start a bidding war, which is going to bid up the value over and above the price of the evaluator came up with, because that's just an independent assessment of the value of the business as at that time, based on a number of factors. And one of them is that there's no bidding wars going on and there's no special purchasers in the market. Now, a special purchaser might be a competitor in your business who sees your business as a good fit with their business. And by plugging your business into their business, they're going to experience a lot of cost savings because they already have the infrastructure in place. Maybe they have excess capacity. So by bringing your business into their model, they're not going to replicate or duplicate the costs involved with generating revenue. So it's more like that old, economic 2 + 2 = 5 concept, where you're actually going to get more value out of the two companies together because of the reduction in costs associated with generating the revenue in your company. That as a standalone business, you would incur certain costs, but being part of this other group, they may be able to absorb a lot of those fixed costs that are already being incurred. And so in those situations, a special purchaser is likely to pay more than the fair market value in your valuation report for your business because of those added incremental dollars that they can make from your company. There will become a point where they'll say, well, we're willing to pay X amount more than this competitor or this potential purchaser will pay, simply because we can benefit from a lot of savings costs by amalgamating you into our operations. So there are a number of areas and a number of situations whereby you may well end up receiving more money from your company than the valuation report has suggested, because of external factors that aren't assumed when the valuation report is being done.
All right, thank you both. We do have another question in the chat, which is around, could either of you comment on any experience you have working with organizations that provide grants or low/no interest loans for Indigenous ownership? I don't know if we have that expertise here or not.
I do quite a bit of work with in economic development for Indigenous groups, and there are a number of organizations out there, and again, it's very industry specific depending on what you're doing, where there are grants and funds available. Over the years, we've built up a network of organizations that we will go to, whether it's there's federal programs, there's provincial programs, and there are also other programs that are available for certain types of businesses and certain types of ownership groups. So they are available. It's just they're very, very fact specific, and it's whether or not your fact pattern would fit into one of their qualifying boxes for being able to access any of this funding. But there certainly is funding available under certain circumstances.
Thank you, Andrew. There was a question around recordings. Where can you access them and when will they be shared? We will be sending a survey at the end of this webinar to help us make sure that we're bringing you topics and content that's as valuable as possible. And Charlene's posted the YouTube link there for the webinar playlist. They are also available on our site under the archived or the past events. Seeing no other questions in the chat at the moment, one question for you, Anthony. Sharon, like what makes a deal financeable, and where are most owners surprised? Like, where are there challenges where people, thought they'd be able to get financing, but it's harder than they expected?
That's a good question. From our perspective, what makes a deal financeable? I think it all starts with the fundamental starting point is if we have really strong, clear financial information, ownership teams, leadership teams that have taken the time to really put together the right information package to communicate to us the value that you all see, those deals typically go the smoothest because we have a starting point that we can gain traction with and build momentum on. The deal team will always ingest all of the information, work through it, begin the underwriting, and that always leads to a set of questions, which leads to more discussions with management, which uncovers more questions. It's a lot of back and forth. But when the management team is prepared and there's no real surprises along the way, it is the smoothest process. Once management teams kind of get into the process and have a very high level of expectation, but have not taken those prior steps to kind of clean up the information or get the information ready for an external third party to digest them, that's where we kind of stumble along the way because we'll get the process started. We'll get to a point where we might ask some questions and then, the information is not available. It takes a couple weeks and it just kind of drags on longer than it necessarily should. So I would say that's the biggest point is if you can get that package ready before the conversations start, that is the best way to kind of kick off the process.
And if it's, I know in a broker deal, you have an expert that's there kind of supporting you in building that SIM. If it's an internal deal, who's doing that and where do I get the guidance to make sure that I'm putting my best foot forward when it comes to financing?
Yeah, so there's a person like Andrew is a good start. Like that, the external evaluator is a good starting point. But you have other M&A advisors that you can engage, and your legal counsel can help you either internally with that, or they can provide you with third parties that they have used in the past that have had successes with in the past. So there's outside people that can come in and really help build all of the documentation that you need to provide for an internal transaction.
Yeah. And for anyone that's interested too, we do have a list of service providers on the Employee Ownership Canada website that are specialists in employee ownership plan design and can help you through a transition process, including supporting you in looking at your different financing options, looking at bringing in, a minority investor, equity holder, lots of different structuring options, and then how you would actually go and communicate those. So if that is expertise that you're looking for, you can certainly reach out to me directly, or you can visit our website to learn more. Anthony, there's a question for you in the chat. Can you please share an example of a recent deal that you worked through from start to finish with just an example?
Yeah, absolutely. I'm not going to get into any details of who the counterparties were or any of the financing specifics, but one deal that comes to mind that was really a pleasure to work through was a deal that a team or a leadership team that approached us very early in their process. They were just beginning to think about it internally. The owner was nearing retirement. He was basically removed from day-to-day operations and was just there as a support oversight head of the board. Was looking to properly transition away and give his employees effective ownership stakes in the company. So we began the very um, early process of just discussing what their um, absolute requirements were, what the nice to haves were, what the deal breakers were, and then slowly started to build a potential deal structure from there. In the background, the leadership team engaged an accounting firm and a legal team to help them kind of put together all the documentation. We slowly got the information packages as they were available, built the transaction underwriting on our side, had a few back and forths with their legal team, with the leadership team itself, a few tweaks to the structure itself, because from an underwriting perspective, when my team takes in information and begins to underwrite a deal, we always have to sell our deal internally to our credit team. The credit team at a bank is the final sign off of any financing transaction. So as we're going back and forth with our credit teams, any questions that they had that we might not have had the information for, reach out to management to get the clarifying details. And then, probably over the course of 6 to 9 months of this kind of a process and tweaking, and the leadership team at the company really honing in on what was important and how their post deal timeline looked like. We closed the deal and have been in a good spot since then. But it's the more time you build into the process and the more you treat it as an exploration from the beginning rather than this expectation of closing quickly, I think that really just level sets for everybody.
I think that's a key point. I think everyone I talk to wishes they started earlier, had more time, because the smaller the window, the less optionality you tend to have. That's certainly something we come across a lot. And also just the time to think about what's important to you. So we talked about the example of like a strategic transaction, right? Where you may get more financial value, but if it matters to you that your organization stays open and under, your logo, or that your culture is the same, then, there's risk in that transaction too. So being able to take the time and try things on and really decide, which path you want to take, and then giving yourself the time to actually be able to execute on different options is really important. To that end, Andrew, I want to come back to you because you and I have had a chance to talk in the past, and Anthony, I think you'll have some ideas here too about expensive mistakes. So if we are embarking on a transaction process, maybe we're 18 months, 2 years out from when we really want to transition. So we've got some time. What are some things that we need to be thinking about to avoid expensive mistakes? And where have you seen people make mistakes that have been really costly to them?
Um, I think one of the big ones for the owner is the potential loss of your capital gains exemption on the sale of the shares. A lot of businesses and a lot of business owners, may have non-performing, non-operating assets within their company. For a number of reasons, they may have a holiday home in there, they may have excess cash, and they may have other assets that are actually not actively involved in the business. And in order to access your capital gains exemption, for the last 2 years before you sell your shares, 50% of the assets in your company need to be at the fair market value of 50% of your assets need to be actively involved in your business. And on the day that you sell your company, 90% of your assets need to be actively involved in your business. So if in the month before, all of a sudden you put a ton of excess cash into your company, then you may throw yourself offside with the qualifying small business corporation rules and lose the access to your capital gains exemption. So one of the key takeaways would be that if you're looking at doing something, make sure that you take a look at your company now and see whether or not you would qualify for your capital gains exemption by virtue of the mix and the makeup of the assets that are currently sitting on the balance sheet, and whether you need to what we call purify your company, which is to make sure that any non-operating assets are removed from the company before the process starts. And sometimes this can be problematic if you're 6 months away from doing a deal and you thought, "Oops, I didn't think about that," and all of a sudden you may have to reconsider some areas because you're not going to be able to claim the capital gains exemption that you thought you were going to be able to claim. So that's probably the big ones for owners as part of the planning is just getting the housekeeping of the company in order and getting ready for sale. Much in the way that you declutter your home or make sure that your home was staged for selling. You want to make sure that your company is pure and that it's a nice, healthy balance sheet with only operating assets that's in there to allow you to claim your capital gains exemption.
Yeah, and from a business perspective, I think one of the more difficult mistakes to deal with is too much leverage off the bat, especially for businesses that are not typically accustomed to dealing with bank provided facilities. Taking on a ton of leverage and really stretching that metric as far as it can go off the bat in this kind of a transaction typically can lead to some hurdles along the way after you're trying to get back into operation mode and growth mode. Leverage comes with reporting, it comes with covenants, it comes with a lot of other kind of ways to spend your finances team's time that we require from a monitoring perspective. So, easing into the process and slowly getting accustomed to adding leverage is probably the best course of action if your business is not already well equipped and accustomed to having that on the books. And don't forget, any transaction that is done with a bank from a finance perspective can always be refinanced, renegotiated if something is not there's not enough or we need to make any kind of modifications to terms and conditions. These are all negotiations that happen over time. Nothing is fixed on day one that cannot be, amended at some point along the way. Even if we do have a committed term, amendments happen all the time. So you're better off kind of dipping your toe into the water rather than jumping into the deep end off the bat.
Thank you. Okay, I have a whole list of other questions I could ask you, but we are right at, well, for me, 1:59 Eastern, so I think we'll leave it there for today. Appreciate everyone taking the time to join us to learn about financing and valuing these EO transactions. If you do have any questions for Anthony or Andrew, please feel free to reach out so we can get those answered for you. And there is a link to the past webinar recordings where you'll also be able to find this webinar recording shortly, and survey for more information on the webinars. If you are interested in joining any of our future webinars, there is an events section on the employee-ownership.ca website. We also generally publish these on LinkedIn as well, so you can follow us on LinkedIn. But on our events page, you'll see our future webinars. They typically happen once a month near the end of the month. And our next one is we have some employee-owned businesses who are going to talk about what it takes to build an ownership culture in their companies and what they've found has worked really well in terms of building financial literacy and a sense of ownership within their staff once they've transitioned to employee ownership. So that'll be a great EO focused session that we have coming up in April. I believe it is the 28th. But if you check out the website, you can register for that. Charlene has posted the link there. Thank you so much for joining us. Thank you again, Andrew and Anthony, and I hope you have a wonderful day.
Thanks, everyone.
Thanks very much. Thanks.